Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. US bond yields once again grabbed attention as yields on the longer end hit new cycle highs. There was some dollar strength overnight, with euro breaking the 1.06 mark as well. We had a few central banker speeches yesterday. I'm sure JK will cover that. JK, by the way, the way things stand, does it look like dollar might have its 11th consecutive weekly rise? What do you think?
It's definitely bordering on overbought territory, but I think we are missing a trigger for it to, correct down. So we look at it a bit closely later. Yes, the yields took most attention of investors as US long bonds got sold for that. 30-year and 10-year yields hit new cycle highs. 30 years, in fact, tanked the most with yields up nearly 15 basis points at the close at 4.67%, and 10s were actually thrashed to 4.548%. 2 years were basically unchanged at 5.13%. Actually, the near term not going up much is an indicative of the fact that the market does not expect a rate hike nearby, and possibly that's pushed back to next year, depending on how the data comes about. But this is basically a repricing of long-term bonds, and the term premium which was missing is coming back into the play. Obviously, it is triggered by the higher for longer theme of most of the central banks and the increased supplies of paper amid market that's actually overwhelmingly long. We also heard the Fed speak that bordered on hawkishness, even from a well-known Dow like Aston Goolsbee. And despite Lagarde's downbeat comments on the economy, almost hinting that no further rate hikes, and IFO survey indicating economy not turning around, German bond yields also touched a 12-year high at 2.8118, indicative of the general bond repricing in developed markets. Even the UK yields were higher by 7 bp. So it's all about the yields, correcting its long-term fall post GFC and also the COVID, and finding their proper levels. But it's a market positioning that has been actually creating more pain for the investors. The stocks were down in most markets, continuing their recent downtrend, but US markets actually recovered their losses and closed in the green, mostly due to short covering ahead of the earnings season that's coming up. Now, as many challenges like possible government shutdown or higher bond yields, even elevated crude prices, all these will ensure that stocks will not see a big U-turn immediately. Of course, we will see the upcoming PCE core price data from US this on this Friday, which can give some direction to the stocks. On the currencies, they were simply following the yields as we hit 11-month high in USD, and with market seemingly intent on testing the BOJ resolve on the currency. Widely expected that they would intervene as we are near 150. Of course, higher yields are a good reason to be selling the yen against other currencies, but it's not the first time that yen has got. So it's been getting sold for several years now, and so I think it must be at a level where the position must be one of the highest in terms of the carry trades. Sterling held just above 1.22 despite a barrage of negative news. It is incidentally the anniversary. It was in fact yesterday, incidentally the anniversary day of the sterling crisis, when it hit an all-time low of 1.0384 in the wake of the most untenable budget presented by the Liz Truss government. And tomorrow is also the anniversary day of the dollar index hitting its long-term cycle high at 114.78, from where, in our view, it has made a long-term directional change. It fell as low as 19.50 from there in July this year, before the correction that is ongoing. We see its potential limited to 107 from the current rate of 106.10. And after that, I do expect a structural downward move in the US dollar to resume. Possibly this will coincide with the peak in the dollar rates, and possibly economy slowing down, of which we have several hints already. This up move to 107 in dollar index will obviously coincide with euro falling up to 1.0520, which I feel is a very strong medium-term support. It's significant that Chinese yuan held well below 7.32 despite fresh bad news from their property sector. Property developer Evergrande faced obstacles for its debt restructuring plans, while another company, Oceanwide, added to investor concerns in an exchange filing which said that Bermuda court had ordered its winding up and appointed a joint provisional liquidator. Coming to our own rupee, its rise to 82.80 proved to be only an easier move as markets reassessed and realized that the flow related to India bond inclusion in the global index will be some time away, and short-term rupee continues to fight the familiar challenges. So it's not surprising that we were at 83.15 yesterday as buyers were back out in action. Dollar index strength to new high at 106.10 did not, however, lead to a breakup in the USD-INR as renewed fears of RBI intervention played out. We definitely have a very strong wall at 83-20-30 zone. In the coming sessions, I feel a revisit below 83 is possible as the half-year end related flows and hedging by exporters can take over. But looking beyond the range of 80-50 and 83.50 is more likely, has higher bond yields pulls money into the US as we step closer into the political events. And a risk aversion due to possible US government shutdown is also likely to keep the safe haven dollar demand elevated. We have quite a bit of data in the coming days this week, and that's likely to keep the markets a bit volatile. Thank you.
Thank you, JK. And just quickly summarizing, US 30 and 10-year yields hit new cycle highs. This was triggered due to the higher for longer theme as well as the issuances of new papers. The key data to look out for this week would be the USPC numbers on Friday, which can give some further direction. For rupee, as we have kept on mentioning, the short-term rupee is facing a lot of challenges. We have covered over a period of time stronger dollar index, higher oil, and weaker Chinese yuan. So, as JK mentioned, we'll keep you all updated for any new or fresh triggers that can cause any reversal, that can display any reversal signs. That's it from us today. Thanks for listening. Tune in tomorrow for another round of fresh updates. Thank you.